For decades, gold has been the undisputed king of safe haven assets. When inflation soars, currencies falter, or global tensions rise, where do investors run? To gold. It's a timeless store of value that has outlasted empires, wars, and countless financial crises. On the other hand, there was Bitcoin. For years, it was dismissed as a digital fad too volatile, too risky, just a speculative bubble waiting to pop. But as we march toward 2026, a monumental shift is underway. Something historic is happening right before our eyes. Bitcoin is no longer just tagging along with gold. It's starting to outperform it and, more importantly, decouple from it entirely. This isn't just about hype or short-term gains. This is a deep, structural change in how we think about money, trust, and storing wealth in the 21st century. So, why is this happening now? Let's break it down. Gold's biggest strengths have always been its physical scarcity and its universal recognition as a store of value. But in today's hyper-digital economy, those very strengths are starting to look like weaknesses. Think about it. Gold is heavy, expensive to store securely in vaults, difficult to move across borders, and slow to settle in transactions. It's an analog asset in a digital world. Bitcoin, in contrast, is a native of the internet. It was born from code and lives on the network. It moves at the speed of information, not the speed of ships or armored trucks. As global finance continues its relentless march toward digitalization, assets that can seamlessly integrate into these new systems have a massive advantage. Bitcoin doesn't need to be adapted for the digital age. It was built for it. Now let's talk about one of the most powerful reasons for Bitcoin's rise: verifiable scarcity. We know gold is scarce, but we don't know exactly how scarce. New gold mines can be discovered. Advances in mining technology can make it easier to extract. Old jewelry and electronics can be recycled. The total supply is always a bit of a moving target. Bitcoin is completely different. Its supply is set in stone, or rather, in code. There will only ever be 21 million Bitcoin. That's it. This mathematical certainty is becoming incredibly attractive in a world where central banks and governments can, and often do, print more money at the drop of a hat to manage debt or stimulate their economies. This programmatic scarcity offers a powerful hedge against currency debasement, and the big players are finally taking notice. For years, Wall Street and other large financial institutions steered clear of Bitcoin. The volatility was too high, and the regulations were too murky. But that's all changing. The narrative has shifted. Bitcoin is no longer seen as just a speculative gamble. It's being recognized as a strategic reserve asset. We now have regulated institutional products like ETFs, secure custody solutions, and clearer regulatory frameworks. While gold is still a staple in institutional portfolios, it no longer holds a monopoly on trust. Another huge factor is accessibility. The gold market has opening and closing hours. It takes weekends and holidays off. Bitcoin never sleeps. It trades 24 hours a day, 7 days a week, 365 days a year, all across the globe, without needing a middleman. This constant liquidity makes it incredibly responsive to global macroeconomic events and particularly appealing to a younger generation of investors who grew up in a digital-first world. As wealth is gradually transferred from one generation to the next, so are their preferences for assets. This brings us to the core concept: the 2026 decoupling. This refers to the growing mountain of evidence that Bitcoin is no longer moving in lockstep with gold, especially during times of economic stress. Historically, Bitcoin often behaved like a high-risk tech stock. When the stock market went down, so did Bitcoin. But we're increasingly seeing it act like a true non-sovereign store of value. It's reacting more to monetary inflation and less to short-term market panic. Now, you might point out that central banks are still buying gold in record amounts, and that's true, but what does that really tell us? It reveals a deep and growing distrust in the very fiat currency systems they manage. Central banks are hedging against their own policies. Bitcoin addresses this exact same concern, but from a revolutionary new angle. Instead of relying on the trust of a central authority, Bitcoin's system removes the need for trust altogether. Its rules are enforced by mathematics and code, not by policymakers sitting in a boardroom. In an era where trust in institutions is at an all-time low, that is a powerful distinction. Let's also consider portability, an often underappreciated advantage. The value of gold is tied to its physical location and custody. Moving a large amount of gold is a logistical nightmare. The value of Bitcoin, however, is tied to cryptographic ownership, here private keys. You can hold millions of dollars worth of Bitcoin on a tiny device or even just memorize a seed phrase. This makes it uniquely resilient in a world with capital controls, sanctions, and financial fragmentation. For individuals, companies, and even nations looking for financial freedom and mobility, Bitcoin offers something gold simply can't match. But let's be clear, this isn't the end of gold. Gold isn't going to zero. It remains far less volatile than Bitcoin. It's deeply entrenched in the reserves of every central bank, and it holds a cultural significance built over thousands of years. The competition is no longer one-sided, though. Bitcoin is graduating from being called digital gold in theory to becoming digital gold in practice, with unique properties that, in many ways, surpass the original. So, the decoupling doesn't mean Bitcoin will replace gold entirely. It means the market is finally recognizing Bitcoin's distinct role. It's no longer just a speculative bet. It's a parallel store of value, meticulously designed for our digital age. Gold represents the past's solution to the problem of monetary trust. Bitcoin represents the future's attempt to solve that same timeless problem, but with a completely different set of tools. As 2026 approaches, the conversation has changed. Investors are no longer asking if Bitcoin will survive. They are now asking how it fits into their long-term portfolios, into sovereign wealth strategies, and into the future of global finance. That question alone signals a profound and fundamental shift. History teaches us that new monetary technologies don't just appear and destroy the old ones overnight. They coexist, they compete, and they gradually reshape the entire system around them. What we are witnessing today is not a rejection of gold's legacy. It is the powerful emergence of a credible digital alternative that no longer needs to stand in gold's shadow to justify its own existence. So, why is Bitcoin beating gold? It's not because gold has failed. It's because the world itself has changed. Thank you so much for watching. If you found this explanation helpful, don't forget to hit that like button, subscribe to the channel, and ring the bell so you don't miss our next video. We'll see you in the next one.